Is ADT stock undervalued? Let's find out, which pulls up all recent insider buying, and it popped up right here. So basically, it said multiple insiders bought within a short window, and I see that its price to free cash flow is 3.9, which means it's a very high cash flowing business, and it has a low PE ratio of 9. Then I go to investigate which insiders are buying, and did they buy a lot? I'd say there's a moderate amount of insider buying. We like to see above 250,000. Houston Daniel Joseph, a director, ended up buying ADT stock, 250,000, and then we see CFO buy, COO buy, Chief Operating Customer Officer, whatever. And then we also see a bunch of this private equity / asset manager selling. That's probably a reason why the stock tanked so much. Look, like almost billions of dollars they've sold in the past. They're probably like trying to exit their positions. I think ADT actually picked up some shares directly from them. They actually bought back a good amount of their shares. Once we click on ADT, we can investigate more. We can see that they bought around $6.66, and it's dropped from $8.94. You can buy where the insiders were buying roughly right now. We see that the EV to free cash flow is 9. The free cash flow yield is 25%. So that's pretty good. And now I want to know more about why it dropped so much. I checked out the Q1 earnings. Here's the Q1 earnings presentation. The main reason I think they dropped was that ending subscriber count dropping by 4% year over year. And the reason why that dropped was they decided to exit the multifamily part of the business and focus on residential. I actually see a lot of ADT houses in the suburbs here in Texas. I do know that they kind of spread like wildfire. Whenever one house gets it, they put that sign in the yard, and then other houses just start popping up. Even though I don't personally use them, I know someone who actually uses them. They have pretty good experience with security. That's good. We do use just the Amazon Ring. I think that's a partial reason of the bear case is people just use the free Amazon Ring camera and they feel safe and they don't want to invest more into home security. However, ADT is there for people who either want the setup to be done by professionals and have like window alarms and other home alarms. And also they came out with ADT do-it-yourself launch. So that's in 2026. They plan to do that as well. That's basically like the Amazon Ring camera. They plan to just have people set up their own. So that's going to help and lower their operating costs, having to pay these professionals to go set up these cameras and stuff. But they actually, for their multi-year guidance, they say that they could get up to 5% revenue growth. And for the 2026 outlook, it's going to be flat. But there's free cash flow is just a money printer, I told you. That's what that price to free cash flow of like 3 to 4. It's super cheap. And then this is just the rest. Most trusted brand. You see that ADT sign, that beautiful blue ADT sign? Yes, I do own the stock because I've already looked at all this stuff. Significant free cash flow generation and efficient capital structure enables financial flexibility, committed to strong shareholder returns via investments in growth and direct returns of capital. Yeah, they buy back a ton of shares. Now let's go back to my terminal to investigate more. We can check out this little revenue and earnings waterfall chart. 25 billion of revenue. So their market cap is 88. Oh wait, no, this is Adobe. Let's go to ADT. 5.1 billion of revenue, market cap 5.6 billion, almost like one price to sales, as we can see here. Cost of revenue, COGS. Gross profit 4.2 billion. So look at that margin right there. And then we have operating expenses, operating income, and then taxes, and then net income. 600 million of net income gives you a PE ratio of 9. We see revenue has been growing since 2021, and I don't know what happened around 2020, and I guess COVID. We see that the operating income and operating cash flow has been going up, and the free cash flow is going up. CapEx has been going down. So then we see margins. Margins look good. We see net margins going up, operating margins going up, gross margins going down slightly, and free cash flow margin just exploding to 28%. Tangible book value is negative, which is normal for such a high cash flowing business, like a subscription-based business. Debt is 7.5 billion. Let's look at how much interest rate the debt is. Average cost of debt is 4.3%. Average debt maturity is 5 years. Let's see, average cost of capital is 6.4. Not too bad, not too bad. That's not an issue really, because there's high cash flow. Look, 1.4 billion. Now let's check out this discounted cash flow model. We can see that the bull case, they said that 5% revenue growth is expected over the next 5 years. For operating margin, we put 27%. We can see right here that the trailing 12 months is 26%. And the free cash flow margin is 28%. We're just gonna put 30% there for our bull case. And we're gonna say that the EV to EBIT multiple returns back to 12. You see that it's mostly been around 11 and some other crazy numbers up here. So 12 is a justifiable number, I would say. Then the base case, we can go with 0% revenue growth, because right now it's 0% revenue growth. And we can keep everything the same as it is right now. Business as usual, it says 25% IRR, which is pretty freaking good. So that I think that's why that's why the insiders are buying. Bear case, we're gonna put -2% revenue growth, 23% operating margin, a slight decrease there, and a slight decrease in free cash flow margin. And then the EV to EBIT multiple, we can even let's put 6. Let's say it goes down to 6, because it's losing revenue growth a lot. And that brings it down to a -7% IRR for a total return of -30% on your money. All right, even with this really bearish scenario, let's take a look at the probability weighted returns. This is my favorite part of my sheet right here. Let's do 50%, 25%. All right, let's say the bear case happens. The bear case happens, it gives you a 23% IRR, which is still really good. We're saying the bear case is 50% likely to happen, the base case 25% likely to happen, and the bull case 25%. 23% IRR. Are you kidding me? That's crazy. And now if we just make it, let's say all these are possible to happen, like you get a 68% upside at this current price. I think all of these things put together, the insider buying, the private equity leaving, and basically the free cash flow just printing. And then you have that bear case just like in the back of your mind, like, oh, the subscriptions are decreasing. I feel like it's to make the bear case a higher likelihood. And you can still get 23% IRR on your money, which would be a double bagger over 5 years. So as you can see on my watch list alerts, these two stocks pop up. You can see that insiders were buying this stock, and then they have super cheap KPIs. And I would be notified by email that insiders bought on these stocks like within 15 minutes. It's checked every 30 minutes actually. And then we could also look at the portfolio. The portfolio, this is what I use to manage my portfolio. Basically, once I put those discounted cash flow model assumptions in, it'll populate on my portfolio tab with the blended IRR, and whatever the price is, it'll like adjust the blended IRR, so I can like easily monitor my stocks, like which ones are overvalued, which ones are undervalued. And we'll see just in a minute here. Okay, now they popped up. So right now, the most undervalued stocks in my portfolio are KSS, which is coal stock, ADT, Comcast, and Transmedics, and FND. So basically, those are assumptions I made one time, and they constantly get updated. And whenever I see a number that's high, that's what I would want to know. I would recycle, like let's say Netflix, I would sell Netflix to buy coal stock because it's a higher return. So that's what I use my portfolio tracker for. And we can tell by my Robinhood account, which I just loaded $10,000 into this account. I just loaded it like last week. I started with $10,143, and I decided I'm gonna start buying stocks that I talk about in these YouTube videos. Well, I'll buy them. So for example, ADT stock I did just buy, and Q2 earnings should be on July 30th. We will have to see how those earnings go. We're gonna wanna track that subscription loss to see how that bear case is developing. And if it turns out to be okay, then shoot, we'll be on the money printing trains. Not a stock advice, but you can see I bought, all of those stocks were bought on July 21st, and I'm gonna buy VOO just to track myself against the S&P 500 from this point on. So it's gonna be pretty fun, me versus VOO. And if you wanna do your own DCF models, just go to plusevbagholder.com, sign in with your email, and then you can subscribe for $15 a month. Check out the video I made on Comcast. It's right here.